Welcome back, options traders, and I hope everybody had a fabulous Thanksgiving. And before we get started, I wanted to give a shout out and a very big thank you to Andrew, one of the traders in our group here. I'm not going to mention the last name, but he sent a very generous thank you through PayPal. Those don't come across too often, but when they do, they are greatly appreciated. So thank you so much for that. So for today, I wanted to talk a little bit about a common strategy that traders have for at-the-money options. And they typically have these predetermined exit points, which I've talked about before in previous videos. But for example, they might say, I want to exit if I get a 50% gain, or if I have a 50% loss, I'm going to exit. For this video, I'm just going to focus on at the monies because the math changes a little bit for in the money and out of the monies. But this is a very common tactic for short-term traders. So let's go find out more what you should expect to happen if you're trading at the money options and you're planning on getting out, whether it's a 50% gain or a 50% loss. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely goes a long way into promoting the channel. So for anyone who might be new, let's do a quick refresher. At the money options, what are they? Well, remember, an at the money option is where the stock and the strike are the same, or at least nearly the same. Now remember, that's kind of a loose definition. The real true definition is what's called the forward value, but for our purposes, this is certainly good enough. So for example, let's say that the stock is 100, then the $100 call would be the at the money call, and the $100 put would be the at the money put. So once again, traders like to trade these because they're very appealing since there's no intrinsic value, but they're also not out of the money. So they feel like the starting line is right there at the current price. All we need is for the stock price to rise. And of course, if we can time that really well, we're going to more likely have these gains than losses. But if not, we also didn't pay too much for the option. So that's really the appeal for the at the monies. Once they've come up to that conclusion, they set some trading rules in place. And so they will usually set, let's say, for example, exit points at 50%. So they will exit if they have a 50% gain, or they will exit for a 50% loss, whichever one comes first. Obviously, the gains are expected and what's desired, but if you happen to get this 50% loss, rather than watching that option continue to bleed away, they say, let me just close it out and move on to something else. However, when you use trading rules like this assumes that you will win more than you lose. And of course, everybody thinks that's going to be true. Everybody thinks that they're above average and that they are the best traders out there and certainly above the average traders in the market. But remember, we've talked about this before, what the math of short-term trading says, or of active trading. So let's say that we have a market, 100% of the people, however you want to divide it up. But let's divide it up into two basic camps, either passive, these people just buy, let's say, the S&P 500 and forget about it. Whatever the market returns, they're happy with. And then there's another segment that we could call active traders. And these are the people that are trying to time the market, getting in and out, trying to beat the S&P 500 through active trading or management. But one thing we do know is that the passive traders plus the active traders have to equal the entire market percent. Now, it doesn't matter which numbers we use, but let's say that we have 30% passive traders in the market and 70% active. Well, what does the math say we should expect? Well, let's say that the market for this given year, according to the S&P 500, returned 10%. It went up 10% during the year. Well, we know that the passive traders got 10% because by definition, they're just buying the S&P 500, holding it, and not worrying about the day-to-day fluctuations. And so the question is, if 30% of the market is made up of passive investors, and the passive investors earn 10% in a year, what must the active traders earn, at least on average? Now, this is where most people will jump to conclusions and say, well, if they're actively trading, they're taking more risk, they should have higher expected returns. Plus, they're probably just better traders, so they're going to have a much higher return. And when I've asked this question in classes, people say, oh, 30 or 40% because they're active traders. Well, the math says differently. The math says that they absolutely must earn the same as the market. Why is that? Well, remember, the market is made up of 100% of the traders, and it doesn't matter how we divide them up. In this case, we said 30% are passive and 70% are active. Active traders have to still make 10%. What if we had switched them? What if we said 70% of the market is made up of passive traders and therefore 30% is made up of active traders? Doesn't change a thing. In order for the market in total to earn 10%, both of these groups must still earn 10%. What if we said it was 90% passive and 10% active? Again, doesn't matter. The active traders have to earn, on average, the market return. So what's the difference? Well, the passive traders, their distribution or their bell curve would look like this. Actually, it's not a bell curve at all. It's just a straight line. Everybody earns, in this example, 10%. They earn the market return every single year. But what about the active traders? The active traders do have a bell curve. And on average, the center of that bell curve will be 10% for the reasons we just saw. But only half of them will be on the winning side, and the other half will be on the losing side. So the thing to see is that the only reason that an active trader makes money is because he's taking it from another active trader who's losing money. Because by definition, the passive traders aren't trading. They're not in this group of people. So now you have to say, all right, well, if that's true, if I'm trading against other active traders, what makes me think that I will always be on the right half of the bell curve here? Because the thing that I find so curious is that all of the active traders use all of the same tools and techniques. Just listen to any number of YouTube videos out there with the short-term traders. They all teach the same stuff. And as I always remind traders, you can't beat the averages by doing what the average trader is doing. There's no reason to suspect that you will always be on the right-hand side of the bell curve. And yet this is an explicit assumption when traders say I'm going to exit at 50%, whether it's a gain or a loss. So let's go find out some more details by looking at an Excel spreadsheet and see what would happen by doing some simulations. All right, so now we're into an Excel spreadsheet. Let me just go through what these fields mean. The first one is the price range. So I've entered 5. That just simply means we're buying options from $1 to $5. It's always from 1 to something. We'll do some different scenarios in a little bit. For right now, we're just going to assume that it's 1 to $5. The next row shows the percent to gain or lose. This is our trading rule. We're going to exit with a 50% gain or a 50% loss, whichever comes first. We can also account for commissions, which we'll do in a little bit, but right now we're going to set those to 0. Now over here in column D, these are just trade by trade. These are just lots and lots of trades. They actually come all the way down here to 500. There's a bunch of them in here, but each row is a trade. So we're going to start off with a price paid, in this example 3, which is going to be a number between 1 and 5. Again, these numbers in this column are just randomly assigned, so they should occur roughly 1 out of 5 times, or 20%, the numbers 1 to 5. So we're just saying, yeah, I'm buying options, I can't control the prices, but I'm generally paying between $1 and $5. So it's picking an arbitrary price. The next column is saying, how much did we win or lose? So it's going to do a coin flip, basically, and say that half the time you win and half the time you lose, which is what we saw according to the bell curve. That's really your best expectation. So in this example, we paid $3, and I ended up with a 50% gain, or a $1.50 gain. The next trade, I paid $5, ended up with a 50% gain, or $2.50. Next trade, I paid $4, ended up with a 50% loss, or a $2 loss, and so on, row by row. The net gain or loss simply sums these up. So let's say this number right here is the sum of those 3. So I'm up $1.50, then I made $2.50, so I'm up $4. Then I lost 2, so I'm up 2, and that's what that positive 2 is right there. That 7 is the sum of those numbers right there. After that many trades, we would be up $7. Now, columns H and I, these next two are exactly the same. They're just accounting for commissions. But for right now, we're going to leave commissions at 0. So the first thing to notice that this chart right here is a graph of the net gains or losses. And as you should expect, it's just a random walk. It's going to have no discernible trend, even though in this case it looks like there is. And this is something that traps a lot of new traders. And they'll think, oh, look at this. I've got a winning system. I've done really well over the past 6 months or the past year. I've got it all figured out. Well, that could just be randomness at work. You could be in a really hot market. You just happen to catch some winning trades. But if you stick with this plan, you're just going to go sideways. So for example, if I hit F9 in Excel, I can do another 500 simulations. And there we go. In this case, we still ended up above 0. Here's 0, that horizontal line, but not by much. And up here we can see the total gain. That's just summing up this entire column. Again, we're assuming 0 commissions. We made $5. That was a lot of work for $5. As I always say, this type of trading, you are picking up nickels in front of bulldozers. It's a matter of time before you figure this out, that you'll just end up spinning your wheels. But to our credit here, we did happen to squeak out a gain after 500 trades. Let's try another one. Now you can see we ended up in the negative. Down here it shows us exactly down $10.50. So the main thing to see is that if we were to do this over and over, we should just see a sideways trend. Sometimes we'll be above 0, sometimes we'll be below 0, but on average we should be right at 0. So rather than continually hitting F9 and trying to keep track of how we're doing, that's what these two columns are doing over here. This is a simulation of 100 attempts of 500 trades. And then it's just totaling the net gain or loss. So here's a series of 500 trades. We ended up down $23. This row is a series of 500 trades. We ended up down $4, and so on. So this right here is showing us the average of all of these trades. And what you're going to notice is that it's going to hover very close to 0. And we can see that because if we graph all of these numbers, we get this graph right here. And look at that, just hovering sideways around 0. So that tells you, yeah, this upper graph, you might have some moments where you're well on top of 0 in this profit zone or well below it. But on average, you are absolutely going sideways. So watch this bottom graph right here. And there you can see, little different outcome here, but overall, just going sideways. There's another one, ended up well below 0 here, down almost $58, but look at that, just hovering right around 0. So yes, you can see you'll have moments where you might be way up, but you're going to have moments when you're way down on average, and that's the important part, that you're just going sideways. Now that's because an at-the-money option has about a 50% chance of gaining or losing, and you are choosing to exit at a 50% gain or a 50% loss. Mathematically, you're just spinning your wheels. But what if we add commissions into it? Let's add a very small commission, maybe 10 cents, a fixed 10-cent commission, and look at that. So now you can see in this case, we ended up with a winning series had we not had commissions, but after commissions, we ended up down here below 0. See over here, we had $35.50 of gains, but we paid $50 in commissions. That's 10 cents times 500 trades. So we ended up minus almost $15. There's another one. Look at that. Even without commissions, we ended up way negative, and after commissions, we were at minus 145. But you can see our graph down here is still going sideways, but notice that we're not centered at 0 anymore. We're centered at the commission because the trades by themselves are expected to net out at 0, but you're always going to pay the commissions. So you can see that if you were to draw an imaginary line kind of through the center of this blue right here, this bottom graph, lines right up at 50. See, if I make the commissions 20 cents, watch what happens now. Now we're going to line up at 100. And you can see that's the center of this blue graph right there at 100. So we're still going sideways, but we're just spending lots of commissions. All right, let's knock the commissions back out of the equation. What if we change the range of option prices? Maybe I'm buying options from 1 to 10 bucks. All it does is it just changes the range. Sometimes you'll have a $10 option where you capture a 50% gain or $5, and sometimes you're going to lose 5 bucks. So again, it's just an illusion. They are all going to wash out in the long run. You can see up here, over those 500 trades, ended up in the negative. And if we simulate that over and over for 100 trades, look at that, just going sideways. And if we throw in commissions here, as before, things are only going to get worse. So the main thing to take from this is that, especially if you're new or if you're trying to be an active trader and in and out of options, especially at the money options, with these arbitrary exit points, it's not going to work. It might be working for you right now, but as we've seen, that can happen just by pure chance. It's not going to work out in the long run. The math absolutely guarantees that. So what's the solution to it? Well, the better way is to approach the markets by putting the wind at your back. Get that long-term upward bias in your favor. Give yourself more time, but hedge your opinion. Trade the market. Hedge off the risks that you don't want. And so if you learn how to hedge, roll, and morph, you can go after the risks that you're willing to accept, but hedge off the ones that you don't want to accept. And the only way to do that in the market, and the most efficient way, is by using options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.